Hi class, this is your instructor. I'm going to be talking about the cash flows today. This is going to be your chapter 13 from William Haka Bettner Carcello's 18th edition. Cash flows are basically related with there's an outflow of cash and there's an inflow of cash. So there are two kinds of cash flows. We're going to be talking about the positive cash flows and the negative cash flows. Why we require cash flows is because it gives a true picture of the capabilities or the capacity of the companies to disperse cash to its creditors, suppliers, and the people who have invested in their stocks and they want to get dividends or receive any kind of interest payments that they have accrued towards them. But similarly, there are operating activities in the companies or enterprises, business, overall business activities. These operating activities are basically important because they give you the true picture of the ability of the company to generate cash. Why it's important is because you can actually relate the net sales of the business or the entity or the enterprise's performance oriented out of the performance that is giving you any kind of inflows. So performance oriented activities result in the sales being converted into cash. However, if there are no customers, or then even if the enterprise is booking you can say sales, but that would be credit sales. So then there are two kinds of sales. First of all, there are cash sales and then there are credit sales. The credit sales, although positively reflect on the income statement, however, they reflect negatively for the cash flow statement because in the operating activities, the company can actually have a negative cash flow as a result of having too many credit sales and not having any cash sales, because the cash flow activity would actually surmise the company's ability to generate cash. So then it can become or retain its status as a going concern, which is the primary assumption in one of the accounting principles, that the enterprise has to be a going concern. That is why this statement of cash flows is very important, because it also gives us the figure of the closing cash, which can actually be posted in the balance sheet. Other than that, it can be compared with the net sales in cash, because we will only consider the sales which are in the form of cash. And any kind of receivables. Now, generally, when you have current asset, such as a receivable, it would be increasing the balance sheet. However, for cash flows, any kind of receivable would be, or increase in that receivable would be, reducing the cash flows, because it would be increasing your debtors, and the ability to pay would be depending upon the aging system of accounts receivable. Other than that, then the payments are scheduled. If you're making payments, then there's going to be a cash outflow. However, if you are increasing your payables, so there's a difference between prepayments, payments, and payables. So if you are increasing your payables, that means you're getting cash that would be reflected positively in the cash flow statement, because either you're getting loans or having some kind of other liability. So if also you're increasing your payables, that means that in an accounting cycle, in the inventory turnover cycle, you are having certain kind of expenses, so for which you have either to make payments for those inventories, or you are dispersing payments in order to settle those. So if you are making payments to settle those, naturally they will be subtracted from the cash expense. So you need to have cash expense where you are making payments. So but overall in the cash flow statement, they will be subtracted from the net sales. However, for cash expense, they're going to be added, because when you make payment, you're going to have a cash outflow. So for the expense part, it's going to be adding in the cash expense, but overall it's going to be subtracted from the revenue portion of your sales. So if you are making a net operating activity statement, then all the expenses would be netted off from all the receipts. In this way, we can have a true picture of the enterprise's ability to make disbursements, receive cash, ability to pay further cash. We are going to be discussing, especially big companies. The reason is because the stockholders usually invest in those companies. Now let's talk about the chapter 13 from the beginning, and then we can, go. And I'm going to be dividing this lecture into a series of lectures. So it's going to be part 1 and part 2, because in part 2, I'm going to be talking about, the direct and indirect methods of making the statement, because from the indirect method, you can actually glean this information that each individual activity is independently of its own. You can account for that. It's easier to understand. However, when you talk about direct method, then it will have the portion of net sales also accounted for. Any non-cash items would also be subtracted, so that from expenses, such that although depreciation, for instance, is a non-cash item, now it is going to be subtracted because it's not a cash expense. Similarly, all other non-cash items would be subtracted. Similarly, we'll also be taking account of the cash and cash equivalents. Now, some students always ask about gold or the bullion standard as having, or as being the cash equivalent. Gold is not the cash equivalent because gold has fluctuating prices. So any kind of a fluctuating price can, make the receipt of the, any income that you might actually want, or any cash from selling of the securities, or cash from selling the gold, although it is very convenient for you to sell it. So it should be equivalent. However, the gold can have various or fluctuating prices to its credit. Therefore, it's not that certain that we're going to be receiving the same amount. So we cannot actually include it in cash and cash equivalents. However, like treasury bills, anything within the 90 days period can be counted as, or the mutual funds, because they are low profile investments and they can give you cash turnover very quickly in the same amount roughly. So we have those as cash equivalents, and not the securities or stocks, even though they may sell at the price in which you actually invested in them. However, they might lose that same status or this price, or they may suffer from fluctuations. Let's just turn to the book now. Okay, so now you see the statement of cash flows here. So like I said, that I would be repeating all this in the second lecture as well, because we have to make the worksheet and then attempt a question. It's very important for you to know the learning objectives, what is the purpose, and I've already explained to you the purpose of statement of cash flows. Then you need to know the transactions, like for instance, what would increase the cash flow, what would decrease it. The major cash flows relating to operating activities is like interest payment, or interest received partially, because when you receive interest, is either you have made some inventory, and then you have put this condition that they will be giving back on excessive amount as interest, or you have lent something to someone, or you've created some borrowers from whom you basically require interest payment. So that would be as per our, basically it is some kind of an investment usually that you make in other companies' securities as well. So any interest received would be counted as operating activities as well, because although there is a dispute in GAAP as well as IFRS that it should be as part of investing activities or not, still we can, to be on the safe side, count them as operating activity. Then there's a distinguishment between direct and indirect methods that we'll be doing in the next lecture, but we would be needing to focus on the components, individual components of how to constitute, or the constituents of the cash flows, you can say. Then we need to also understand as to why this net income would differ from net cash flows from operating activities. I've already explained to you the reason, because we need to make both of them congruent so that they converge to the same value. So if usually we have cash sales, then the figure from operating activities and the cash sales would be the same. The problem usually arises when we have credit sales. So any sale on account would not be giving you cash unless it is converted, or that receivable is reduced. If there's an increase in receivable, that will reduce cash flows. And let's just get on with it, because all of the others, including the worksheet as well as the strategies, would be discussed with a question. Okay, there's a large company, and it's basically it's PepsiCo. It's a multinational company with the statement running in billions of dollars, and they have generated a lot of positive cash flows. One of the secrets of its success. We just go ahead with this case. This is primarily one of the ways through which you can actually learn about the company's being a going concern in the first place. So now, what is the purpose, basically? If you go into the details, it will tell you that the main objective, even from the examination point of view, you can just have maybe some kind of query in the exam or some professional certification that you do, that what is the main reason. So you should always know that it's the ability to generate cash, it's the need for external financing. So you go to the bank and you want a loan. The company's position of cash flows is one of the most important aspects which a bank would not neglect in determining whether they want to pay disperse loan to that company or not. And then there's a difference between the amounts of net income and related cash flows, already discussed amply. Now there's as you can see, we have a statement of cash flows. Generally, it looks like this. You just have a brief idea about it. And now, if you can see that they have three kind of activities. Okay, I'm just going to be going slightly towards what kind of activities we have. We have the operating, investing, and financing activities. These are the three kind of activities usually dealt with in cash flows. Operating activities deal usually with the day-to-day operations of the company, which would include generating sales. And for that, you require inventory, and that would require cash payments to the suppliers generally. We're not talking about loan, because that loan is to finance the business. So that would come under financing activity. We're talking about usually the payment cycle of the inventories if it's a manufacturing concern, or if it's a service sector, merchandising sector, then that would have some other sort of requirements. But so far, you can see that any kind of cash which is received from customers, and that is a positive. Now, if any kind of outflow is done, it is reflected in the brackets, and any kind of payments like interest paid, taxes paid, it's an outflow. Now, that is very easy to determine, because so far it's paid. You already know that it's a cash outflow. But the confusion lies when they're talking about payables, right? So they have to be netted from these. So if it's an interest paid, then you have to see whether there's any payable adjusted with this. So if there was an increase in payable, then that means that will be reduced, right? So interest payable would actually reduce this amount, and any decrease in payable would actually increase this amount, because naturally when you are increasing a payable, that means you're receiving some kind of cash. But if you are reducing the payable, that means you're settling it down, or settling it off with the cash payment. So that means the interest paid should naturally be increased. Remember that with the paid, it has to reflect the kind of expense that you're doing, and you have to match it with the payable, and the kind of payable that you're doing has to be the same. Similarly, for suppliers and employees, any kind of payments are negatively supported with a bracket, and any kind of receipts from customers are added, and that is the simplest form in which you can easily see the net of after disbursement. Total disbursement, just add this, and you add both the receipts, cash receipts from customers, and interest and dividends received from various kind of activities that you do, or maybe some kind of investment that you do. That is reflected in this. When you talk about investing activities, now any purchase of marketable securities out of which you can have interest received, but that interest received would go here. But any purchase would be, again, supported by a bracket. Proceeds means basically that now you are getting some kind of a dividend perhaps, or proceeds from sales of, that is the dividend. Again, is the question, there are two kinds of dividends. their dividend received would be actually maybe part of the operating activity, and but dividend paid would be a separate story altogether. I'm just going to be discussing it later. Now we're talking about the sales of marketable securities. That is very simple to understand. You purchase it, it's an outflow. You receive it, it's a inflow. After selling those, any proceeds that you receive from selling the marketable securities. Now, loan, there are two kinds. The one loan that you make towards others, and the loan that you receive from the banks to support your enterprise, or you issue bonds, stocks. So that would be financing activity. If you can see that you can't confuse both things. So there could be, if it is mentioned somewhere, proceeds from short-term borrowing and payments to settle short-term debts. Okay, so that would be a debt. Now, if you have, this is actually loan made to the borrowers rather. So those borrowers who have borrowed from the company. Now that would be investing activity because the company is actually having a side business. So for instance, if it's a bank, they would have surplus funds from the operating activities, and then they would be into reinvesting that or injecting those funds back into the business, or they would be if it's for expansion purpose, they would be injecting it back to the business. Otherwise, they would be investing in securities or giving out loans to other people, foreign trust, things like that. It could be made to borrowers, and that could be one of the form that you have debtors. So in that way, you will be any kind of, that would be part of investing activity where you are actually making it as an investment. Then collection on those loans. Now any kind of payment again made to you would be a sort of receipt, but that is from the investing activity. Any kind of disposal of plant assets would be resulting in proceeds, and any kind of purchase of plant assets would be reducing those. That would be supported by a bracket and a negative sign. Either of those, either you write the bracket or put the bracket or a negative sign, but you don't put both. And that will be a net. That will give you a net cash flow from investing activities. All you have to remember in this lecture is that what to put in as investing and what to put in as operating activity. Usually, students would get confused between the loan and the interest. So if you are making, investments, they will be investing activity. But if you're receiving interest on those, that will be operating activity. Now, if you are, supporting your business, although there could be an argument that you can support your business from investing activities, however, those funds are not enough to support your business. You really need lots of funds to, set up your business and then keep it going. So you need a loan from banks. So that would be, now either when you make loan, that is an investing activity, but when you are getting a loan approved, sanctioned, that would be an financing activity. So either you have stocks, or you have loans, or you have bonds. Payable, that would be financing your business. So proceeds, any kind of proceeds from issuing bonds payable would give you money, your business money to be set up. So that is positive. Payments to settle short-term debts, any kind of loans from banks. So, why we are talking about short-term debts is because cash flow is for the present year. It is not for coming accounting periods, it's for within one accounting period. So you will be talking about the short-term in that case. Similarly, we have bonds payable in the same sense that we have stocks, because you either issue bonds or you issue stocks, so you have to pay coupon on that. If you are, receiving funds, that would be added. However, if you are issuing coupon, that would be in the operating activity again. And then you have dividends paid. Like I said, this is different from dividends received, because when you receive dividend, that should be either an investing activity or you can have it as an operating activity. But dividend paid means that now either out of the financing activity it rose, that could be as part of the financing activity, you are paying off the dividends to the investors in your stocks. So then you will have the net coming from this. Now this is, if one is positive, the other is negative, you net it off, right? So now this is 50,000. And this is from investing activity, again this is negative, and from financing activity it was positive. So then you can just simply, this was 100, and then this was 115, so this is a negative 15, and that could be 35, and then you can have an opening cash at the start of the business, just like you make a ledger. Although ledgers are, always remember that they are on accrual basis. However, the cash and cash equivalents generated from cash flows are on cash basis and they're not on accrual basis. So even if you see the ledger with task carried down, brought down, it is because you have to either pay or receive in the future. But cash, in the beginning, you can see for the ledger of cash, the opening balance is always there. Either it could be 0 or some value, whatever it is, you just add that. If it's a net increase, you just add it with that. If it was a net decrease, it would be netted off here, right? So there goes about the most common use of the most commonly used cash flows format. And let's just go ahead with operating activities. Now they have given you an example where they have separated the receipts and payments. You can always remember and come back to it for attempting your questions. In trust, these have been discussed. Process for settlement has not been discussed. This is rare. It's a one-off thing, and that could be giving if it's something that you received, it could be a positive thing. But if it is something that you have to pay to someone, it would deal a negative blow to your cash flows for the time being. But they might not be precursor to having hampering process for your business. However, it can reflect that there is some kind of hitch or an inability of the enterprise to handle the business or satisfy its customers. It also depends, or it can give an auditor an insight into the practices of the company as well. So you have investing activities. I've already told you about the plant assets when you sell or purchase. Although you finance that asset through the financing activity, but when you sell it or you further purchase or you expand your business, any kind of investment is reflected in that activity. So now we have financing activities dealing with stocks, bonds, and loans that they take from the other companies. But when other companies take it from them, they will be inserted within this range, investing activities. Then let's just go towards cash and cash equivalents. I've already discussed that with you. You can just simply see that. Cash versus accrual information, again discussed with you. You can just simply go through that. Now let me just quickly go over that. It's very important and pertinent for you people to go over this before we talk about the worksheet in the next lecture, because it would be impossible to consider it in as a mutually exclusive thing or independently. It has to be done collectively. Next, we have an income statement, and then they're just given you simple examples of that. What I would be interested in is how to glean information from all that haphazard stuff. You already have net income from this, So any kind of net income given, income statement given to you in the exam, you can just simply see that what you require is a net income, and then you have to go for the adjusting entries that they have made. So we have, this is basically sort of like beforehand information about any kind of they can give you a question about the closing balance sheet and the opening balance sheet. However, so you have to see and decide from the question whether it's an opening balance sheet or a closing balance sheet. So this is now two balance sheets side by side, and this would actually give you information about the the closing inventory here, and the accounts receivable, whether they have increased or decreased. So basically why they've given you side by side is that you can just determine that during the year what happened. So this is cash and cash equivalents have increased. Okay, so this is basically the current assets. That means that they have actually had some kind of positive cash flow generated from the overall activities. Marketable securities, as you can see, that they have increased, and the notes receivable has increased. That means that would be having a reducing effect on the cash flows. And marketable securities have increased, that will be increasing your investing activities. And this example is very interesting and important before you can actually make room for deeper questions. But before we get into that, see that there are adjusting entries, and some very short questions are very important for you to, before you cement your, you have to cement your base before you can actually jump into something more technical. So my advice is to go over these singularly and then go towards the, the overall position of cash flows. Now, when you talk about the investing activity, for that, okay, operating we have already discussed, but just let me reiterate that accounts receivable increases by 30,000 during the year, and dividend revenue recognized. So it says that when you analyze, I've already told you that if you see any increase, then you can just simply jump to the conclusion that. So I've already told you that in this case, they say that account receivable was increased. So do we have account receivable from 80? So it rose to 110,000. So that means that now this is 30,000 increase. Similarly, we have dividend revenue is recognized on the cash basis. Notice that they're using the word dividend revenue and not dividend paid. So in the exam, it's very crucial that you differentiate the two. But interest revenue is recognized on the accrual basis. It could be interest revenue recognized if it is a payable or a receivable. So you have to net it off. Any increase or decrease could be netted off. Accrued interest receivable decreased by $1,000 during the year. Now we have to see. Then there are two things. Now first is the dividend revenue, and then there is the interest revenue. Okay, accrued interest is. Let me see. There's interest receivable decreased. Okay. So we have a note receivable here, and we have interest receivable here as accrued. Accrued means something which is pending, and it is reducing by 1,000. So that means the receivable has actually been either paid to you, and it will be increasing your cash flows. That's how you are going to be setting up the profile for the cash profile now in this case. So you know that this is decreased. And how do you take the effect of these? And inventory increases by $10,000. So either you have made payment for that inventory, it's going to be adding to your expense because now you have purchased that inventory and payable increased. But now there are two things. Now when the payable is actually increasing, that means that overall the cash flow can increase because either you have secured some money for it. But when it comes to payments, the cost of goods sold would increase in this case. So any kind of increase in inventory would by 10,000 means that the cost would be increasing or going up by 10,000. But if payable is increased, that's a separate issue because it's a liability. Any kind of increase in liability would be reducing that. So during this short-term prepaid expense again would be increasing because that's a prepaid that beforehand that you're making a lot of payments are being made throughout the year in form of cash in advance. That's why it's known as prepaid. Now let's just go over. Just simply go over the changes, the effect on the plant asset account. We just given you the individual aspects of that you when you purchase. Now what happens is that when you sell something with a book value of 44,000, you sold for 75,000. Effect on plant asset account. Overall, that would reduce the value of the plant asset, however, but it would be increasing your investing activity. Cash, you would be getting cash for that. So even though the cash plant asset with a book value of 44,000, so you have to reduce the book value because it's a historical cost concept here that when an asset is disposed of, it is naturally reduced by the amount at which it was purchased, and then anything ahead or further than that is termed as gain or sale in income statement. Recorded depreciation expense, again that's a negative, but what do you have is purchased 200,000 plant assets, paying 160 cash and issuing a long-term note payable for the 40,000 balance. So at what price you purchase is 200,000. So anything that you sell off is netted off in this. So this is basically a balance sheet aspect. And now you have all these differences. Now let's just go back to something which is more crucial for you. The first thing that you have to do is that you have to understand what is the impact of what are the overall effects of all these transactions. So for instance, if you're receiving cash, I would recommend that you read this first and then you go to the format overall so that you can make sense of the entire statement. So when you receive cash from from customers, then that means that this is net sales in cash. We already discussed that we're not going to be taking up credit sales in this. So any decrease in accounts receivable, now you might think that any increase in accounts receivable would be good for sales, but because they will be creating your customers. But like I said, that since it's a credit sale item, we will be reducing that from the net sales. And any decrease in accounts receivable means that now people are actually paying you off. So you're getting some cash in lieu of the stuff that you sold to them. That will be increasing your net cash sales, right? So if you see net sales, any on accrual basis, that they have just separately discussed accrual basis, but we're not going to be, having that as part of our cash flow statement. Net sales for the year of 900,000. So this is accrual basis now. Net sales less any increase in account receivables. So you can see that they have reduced the account receivables. So now you can know that this is the overall statement, and we can usually talk about the accrual basis with cash for the cash flow statement. But if it is reporting, because it is overall the income statement or other statements are reported on accrual basis. So that's why they have written this as such. Next, we have interest and dividends received. Now, interest received is something that you get out of the investing activity, and interest revenue is, it is increased by any decrease in receivable. Like I said, it's any payment made to you, because any receivable or current asset other than cash, when it is increased, then that would have a negative impact on the revenue, because you will be creating further debtors, or someone has to pay you, hasn't paid you yet. So when they pay you, this receivable reduces, and that increases in turn the interest received portion. So if you had the total figure as that, why they have said this is as accrual basis, because that would be most likely reported in the income statement. So you have to reduce whatever was the accrual part of that. So decrease in the interest receivable now means that you can just simply add that up. The amount of interest and dividend received are combined for presentation in the statement. Now, like I said, for the cash flow, you can only have the cash basis. So interest received and dividend received, that is very simple, because it does not constitute or incorporate in it some kind of payable or receivable. And remember that for receivable, you will have you'll settle the receipt with the receivable and not the payable, because payables will be separately settled. Just like this. So we have purchase of merchandise, that is cost of goods sold, and any increase in inventory would be added, as previously mentioned. Decrease in inventory would mean that you have not settled the account and the cost is reduced. And a decrease in accounts payable means that now you have paid out cash, so that should be added. Although it would, any decrease in payable would be a cash outflow. But see, in the cash outflow, as a cash statement, you can just simply say that for the cash statement, this decrease would be a cash outflow. And then that would be reducing from taking it, as a setting off aspect of from the revenue, you can say. But when you are computing the payment side to net it off from the receipt side, first of all, you have to add this, because there will be the cash outflows. So you have to add all the cash outflows. Then you will subtract them from the inflows, right? So in this case, when you decrease the payable, you are giving out something. Naturally, if your payable is, I'm liable to pay you some money, so that is a payable towards you. But if I'm paying you, so that my liability now would be reduced. So that means I paid you, so that's the outflow. And then again, so this is simple, but you have to just keep it in mind. Cost of goods sold, and then you have increase in inventory will be added. And net purchases, which is accrual basis, would be either as reported as a net off. If it's a decrease in inventory, obviously, then that means that I will be subtracted from this, and then that will be a separate figure. Increase in payables to suppliers. Now that either I told you you can use the bracket here, or you can just simply use the mention less. It's one and the same thing. So cash payments, now when there's an increase in payable to suppliers, then you either received cash, or in lieu of that you just sold the inventory and you received cash from that. But payments for purchase of merchandise you can just simply have, but any kind of payable would reduce that. Other than that, there are also prepayments. You can just read up on the theory part, but cash payment for expenses is any non-cash item, like I said, that has to be reduced or subtracted from this, and the prepayments are added. That is very simple, because you're just making a payment, whether in advance or not, is not the concern. It's an asset, although, but it's nevertheless a cash outflow. Similarly, we have liability. Again, it is decreased. So we are making some payment to decrease it, right? So we are going to be adding it up, and vice versa. Then you have, see, this is the, any kind of expense with which you have. Now, when you pick up the income statement, more likely in the direct method, you have the net income, but it will also have the depreciation as being netted off to you. Then you have to add it back. And in this case, you have the non-cash expense, so you're going to be subtracting it from this, but because even though in the income you added back, but for the expense, you're going to subtract it. So it's one and the same thing, always remember that. When you are subtracting from income in the income statement, then you have to add it back in the income when you are computing the cash flow statement. But when you're computing the expense, then you have to subtract it. So you subtract it from the expense, or you add it in the net income. It's one and the same thing. An increase in short-term prepayments. Obviously, that's going to increase the expense payment. And decrease in accrued liabilities. You're just making payments, so that will be added up. And then just overall, you just get the net position of cash payments for operating activities. Any kind of operations involving, supply of goods, or purchase of goods, or creating debtors or lenders in this process that you're selling the inventory, or purchasing the inventory, that would constitute the operating activity. Or interest received on account of any investing activity that you do would be included in that as well, including the dividend received and interest received. But sometimes dividend received is also included as part of the investing activities. So then we have, again, this payments made is simple. You just have to be wary about the receivable and payable aspects. Now, as a quick look, that you can just simply see that operating activities and investing activities, and then this is just the operating activity, just what we have done before. You can just simply have a quick look to this, at this, and now we have the purchases. So any kind of purchase would be, and this would be netted off. Any outflow and inflow will be netted off here, and loans that are made and collected are netted off here, because when you collect on loans, that is your investing activity. But that is just for the necessary information, so that you can just simply see that when you are making loans to borrowers, I'm not talking about the loans that you are taking from the banks. That would not be netted off from here. These are just the loans that you make to them. That is a cash outflow. But when you receive money on account of that loan from the borrowers that you created, okay, so that will be added and netted off. So this is just for you to understand and see. That has all been discussed. Just go over this so we can take the questions in the next lecture. Okay, this indirect method, like I said, there's indirect methods, the direct method. You can just simply compare them. So a direct method can involve, direct, independently, but indirect method can also have independently, but however, it has a separate approach to it. So you have to add or subtract certain things. For certain companies this is practiced, and for other companies this is practiced. Both can be easy at times, but it depends upon the the viewer, or whichever method they prefer. But the quick review is that for direct method, you can just simply have these related as they're not intermingled like this. So this is just, by operating activities, you can simply have a good picture of net income from the income statement. Then you can just add back the depreciation expense. And why you're adding, like I told you, that you have added back at times because you already subtracted it from net income. Increase in or decrease in expense, accrued interest receivable. So that means that now, although it is an asset, but since you have, if had it been increased, that should have decreased this net income portion. But since this is decreased, it means that you received some cash in lieu of the receivable and you settled it somewhere, so you're going to add it. Increase in payable, again, you get some cash for it. Interest liability increase, you get some cash for it. And non-operating loss, so this is a loss on sale of marketing securities. Although now you sold, although it's a loss that will be netted off from income statement, but whatever money that you got from sale, you just put that here. But then you're going to subtract the increase in assets other than cash. Increase in inventory is an asset, prepaid expense is an asset. So any increase in the assets would be subtracted. Now, any decrease in liabilities would be, again, see, if had it increased, that would have been added. So now decrease would be, again, that would be in the expense that is added, like we did before, that when you are decreasing a payable, you are paying out cash for it. So that's an expense and outflow which you will add together. But when you are subtracting it from the net income, it's because that is a receipt and this is the outflow, so they can't be added together. You have to be very careful about this because we did this above. If you can just see in here, see cash payments. Now this was the expense part where I said that decrease in liability is added, right? So you can't confuse this with this. See, this is a payable. Now you have reduced the liability, although it will be added in the expense, but it would be reduced. It would reduce your, net income in cash because you are paying something off to reduce that payable. And decrease in, again, payable, so that any decreases as an expense is an outflow, and increase in receivable, that is also sort of like an outflow. Increase in inventory because you're purchasing, so that's an outflow, and any kind of payment that you make is also an outflow. So all the outflows are subtracted from the inflows, and you get this is the indirect method, and then this is sort of like an individualistic style. Some companies really prefer it because it takes you from one end to the other. Convenient to you. That would be somewhat separate and also exclusive in the sense that you can just simply compute it. If a short question comes to you in the exam, then you can just simply compute this from operating activity, just whatever that you received. But that can be a little difficult to understand at times because now you have to make short notes to what this figure will be netted off from some working that you did, in which the receivable was netted off from this received and reduced that received. So interest and dividends, anything received, provided by operating activities and then paid to suppliers, easy to understand, but can be quite confusing when you have to resort to reading about the workings, working one, or notes. Especially the cash flow statement is a bit long. And here this is just important because you can just simply view each independent transaction. And I think that should be it. Then there's just talking about the time difference, the drift. If you catch it, it's about the net income and cash flows, time differences. Whenever revenue or expenses are recognized, but we know that net income is on accrual basis and this is on cash basis, there could be time differences in prepaid expenses to convert into expense, but generally the picture is quite accurate. And Sometimes what happens is you report something as a receivable, but then it could be settled. So there could be a time difference in that. However, it also depends upon the interval within which you have reported this. So towards the end of the year, if it has not been received, so even though the picture clears for the next year, but in that current year, it is such that it will be, reported prior to the receipt that you got. So next we are going to be doing the worksheet, and singularly we'll be taking up questions. So there is some aspect of free cash flow. I want you to also see this, what free cash flow is. We're just going to be studying it and some other small portions before we start attempting the questions. And then we are going to be doing the worksheet. Let me just show you what the next lecture is like. I hope that opens. Okay, I think it's in the next part. Yeah, something like this. This is a worksheet where you have to work through this example, the problems, how you're supposed to make this. Again, just either it is in isolation, like I told you that you'll be given some notes, so you have to read up on those notes so that we can just prepare that worksheet for one question on the board. So I thank you, class. This lecture has ended. Let's just go towards the numericals for the next lecture. So I would be signing out now. Thank you very much.